You may be finding yourself in a position today where you've got a lot of money in the bank, and fortunately, most banking institutions are paying you a higher interest rate based on interest rate increases with the Fed over the last 18 months to 2 years. But as we look at things today, you may be looking to say, well, I like this great interest rate. How do I extend the life of that further? Well, unfortunately, most positions that you're finding in bank type positions are really looking at 12 months or less to offer the kind of interest that you're looking to find. So if you're looking to get 5% or higher interest for a longer than a year time frame, where do you go? That's what we're going to look at with our time today. Hello, my name is John Vandergriff. I'm the Wealth Planning Team Lead and one of the owners here at Blue Ridge Wealth Planners, where we are helping people have solutions to a question very much like the one we're asking today, especially when you consider that inflation rates have come down. More and more people are predicting that the Federal Reserve is going to cut interest rates in the coming months. That will have a noticeable impact on the safe money that you have today. And so a lot of people are asking the questions of how can we extend the life of these really good interest rates whenever that federal interest rate starts to drop, and more than likely everything else will start to come with it. So I'm going to show you a couple of options today that we're having conversations around just to really try to preserve some of the value and buying power of some of these safer areas today, and really see if those could be something that could be a match for you. So as we look at this, today the current Fed funds rate is 5.33%, and as a result, what we're seeing in a lot of different places, and I'm not picking out individual banking institutions, but most money market positions are paying somewhere between a 4 and 5% interest rate, which leaves that money available and liquid. If you're choosing to tie that up, you may get that same 4 or 5% for CDs for more than likely a 12 months or less time frame. Now, are there outliers? Could you find a CD that could go 18 months or 13 months? Sure. But most of the time, if you're looking anywhere 2 years or less, that's where you're going to be able to get returns. If you start to exceed that, more than likely those CD rates are going to drop, because as we look at this, when the Fed funds rate is up, that allows banks to have the opportunity to make money off of money that they're holding or borrowing. And so as we look at this, they're in a position where they could share that with their shareholders, and whenever that starts to drop, they're in a position where that's not the case anymore. And so that's why when we see the rates come up, they go up a little bit, but when the rates start to drop, you see that fall in your savings, unfortunately not as fast in mortgage or borrowing rates. So what are some options that we can take advantage of if we're looking to say we've got this good interest rate, we know it may not be around very long, how can we extend the life of that for maybe a 3-year or longer time frame? So one of the things that exists today is what's called a multi-year guarantee annuity. Some people will call these MYGAs. This is what's called in the traditional fixed annuity family. And as we look at these operate a lot like CDs in that you have a fixed interest rate for a fixed period of time. And so as we look at this, as of July the 11th, which when I'm recording this, the best 3-year MYGA rate that we can find in the 30 different companies that we're licensed with is 5.9% per year return on a 3-year CD. And that's a compounding 5.9%. To where after 3 years, whatever you put in there, you do the math and you've got that much more money. As we look at this, if we're wanting to extend this and we have some money that we don't really have a need for and we're okay tying up for a 5-year period, 5.8%. So not a huge drop, but a longer period of time that you can take that interest rate and extend it further. So as we look at this, the choice that you have to make a lot of times to try to preserve the wealth making opportunity is whether you're willing to tie up those funds or not. So that's why we're seeing money market rates being somewhere between 4 or 5, but then you get a CD that's 2 years or longer that's paying you 4% or less. Some of that has to do with the Fed funds rate, but some of that has to do with the likelihood that they think that this is going to make money in current environments or moving forward. So it's actually backwards, and this is a result of what we call the inverted yield curve, where normally you tie up something for a shorter amount of time, it pays you less than if you tie up something for a longer period of time. because that yield curve is inverted, most people think the interest rate environment will go down in the future. That's why you're seeing, even in a 3 to 5 year, this paying less, which when normally this would be reversed in normal interest rate environment conditions. So, but what's good about this, our clients today are able to, for money that they're wanting to reserve for a 3 or a 5 year time frame, be able to lock in a 5.9 or 5.8% return, which gets them over that 5% threshold that we talked about at the beginning of our time. Now, another interesting tool that we use here that could yield 5% or higher, depending on what happens, is a fixed index annuity. A lot of people have different opinions about annuities. Some are very expensive, some don't grow very well. Because of interest rate increase, the positions that we have today are pretty attractive. But fixed means it can't lose money. Index is how it will most likely track the growth potential. These do have fixed account options, which are paying 5% today. But if we wanted to get a higher growth potential, we could track indexes like the S&P 500, where we'll get a percentage of the up with no downside. And I'll talk about how that works. And then annuity, today, people will sometimes tie that to an income or a pension-like payment. More than anything, annuity can mean a lot of different things, but it means an investment with an insurance company. These are not designed to tie up your money forever and only pay you an income stream. A lot of times we will use these as bond replacements for some of our clients, where we have a safe investment that we can take withdrawals from, similar to the way people used to use bonds before they allocated them into mutual funds and tried to play the market and bond side to either make or lose money. So the positives of this, we do not have drawdowns, so worst case is zero in your return potential here. You do have potential upside on the market. If the market's up, you'll have the chance to make. If the market's negative, you get a zero. And then if you don't want to have all of it based on a market index side, you could tie it up in a fixed position. Like we said, current rates are paying 5% in those fixed accounts. So that would be a way that you could tie up, a 5% return today, plus get maybe a little bit more upside depending on what you look at. What are some drawbacks of this? Because there's pros and cons to everything. You do have a 5 to 10 year surrender period where if you needed more than the 10% free withdrawal that's available to you, you would have surrender charges that are assessed to this, which is why you don't want to put all your money here, just like you don't need to put all your money anywhere, okay? But again, as we look at this, because you're reserving this money up for a period of time, it allows you to get a good growth potential off of the market inside of these positions. So I always like to talk to people through how these work, because there is some misconceptions here. So what we're seeing today, the best cap rate that we can get on the S&P 500 annually would be 11.75% on an annual cap rate for the S&P 500 index. So that's where those rates are today. As interest rates fluctuate, that number could change. But as we look at this, let's say you put $100,000 in, and the first year, the market is up 10%. Well, the way this cap rate works, if you make anything between 0 and 11.75, you will get all of it based on the price index of the S&P 500. So if the S&P is up 10%, you would get all 10%, so you would have $110,000 in your account, and then that would lock in. Let's say the next year, markets don't like policy changes for whoever the new president is, or we have some kind of economic problem that causes the stock market to go down 20%. Well, the good news is for you is you've locked in your growth and you set flat for that length of time. So then what we have seen historically, and this is not a guarantee, but normally when we have a down year in the market, we usually see that followed up with an up year. So if that were to take place, if it continued down, you'd continue to sit flat. But if it went up, let's say 15%, and we were still in 11.75 cap, then you would be in a position where you would cap out at 11.75. You wouldn't get the full 15, but you would be able to get to the top of that cap rate and then lock that return in again. So as we look at this, what's nice about these types of positions is if we want the money to be safe and we're willing to, tie it up to some degree to where 10% of whatever's in there is an okay access point, which if you're in a CD, you're really only available to get the interest. If you're in one of those fixed annuities, it could be either 10% withdrawal or the interest off of it. most of the time you don't want more than 10% off of a safe bucket, especially if you plan your assets correctly. So this could give you something that gives you growth potential. And so what kind of growth potential are we looking at? Well, I took the time frame just since 2000, which is the most recent market information that we have. And so your true worst case scenario, let's say you're in a 5-year fixed index annuity, worst case is 0. It could not return anything for the entire 5 years. So again, that if that happened, that would mean the market was negative all 5 of those years, and you may be happy with a 0 return potentially. The worst 5-year period that we have had in the market since this time was actually January 1st of 2000 through January 1st of 2005, and these operate on an annual time frame. So that would be 5 years. And if you had this 11.75% cap that we just talked about during that time period, your worst 5-year return average would be 4.02% per year. So a little less than 5, but this is if we were just depending purely on the market in the worst period we've seen in the last 23 calendar years. If we took the best, that just so happened to be the last 5, and we take that, and basically 4 out of those 5 years you capped out 11.75% per year. That would put you at almost 9.3% return per year, which is noticeably higher than 5. So none of these are guaranteed returns. This is purely just basing it off these annual time frames. But what's interesting about this is there are some unique ways that you can make money on safe money today, and that's what we want to talk people through. Not that you need all your money here at any degree, or none of our clients need all of their money tied up in insurance positions. You need to make sure you balance liquidity, protection, and growth potential in things like the stock market, and we work in all 3 of those areas. But really just wanting to highlight this for those that are really maybe worried now. What's interesting with things today, we also have, with interest rates potentially going down in the future, we are at all-time highs in the markets, depending on which day you look at it. So when you have a high market, it's usually a good time to decide if you want to go more conservative so that you can preserve some of the growth potential that you have with risky money. But even if you're sitting on bank money, most of the time the recommendation isn't to throw that into the stock market at all-time highs either. So if we're looking to continue to extend conservative uses of this money, this could be a tool that's a match for that, depending on your situation. And so that's what we want to invite you to do. If this sounds like something that you could be interested in, we need to talk to you first. Okay, this is not you click this link and you sign up for this thing. You don't know enough about these positions to be able to see how they fit into your big picture plan. And so if you see the link below, we would invite you to click that, set up a time where you can talk to us about what you're looking to accomplish, maybe what your safe money's in now, and what your plans are moving forward, and how we can guide you the way we've been able to guide a lot of families in the planning process as a whole, but using tools like this to really execute those plans and make sure that people are, preserving the buying power of their money, hopefully trying to keep it ahead of inflation moving forward. And that's the things that we're looking for in some of these safer investments today.